market strategy. Steve Weeple, head of U.S. equities at Standard Life Investments, and Ron Ianieri, chief options strategist at Options University. Steve, I want to start with you. We're going to get into Merrill, but I want to start with a bigger picture. With a big sell-off, about 2%, but volumes were light, the financials got hit. I mean, give people a sense of your viewpoint of the markets right now.
Sure. Well, I think what's really happening is we're giving back a lot of the enthusiasm that built up during the early part of second quarter reporting season. And a lot of that enthusiasm was driven by the sharp rally in the financials. And for the first time, we had banks management saying something marginally positive about the banking sector. There were no big capital increases, and the market had been scared that we were going to see some of that. Banks like Citigroup and JP Morgan were able to post reasonably good numbers out of their fixed income trading divisions. And on balance, the reporting from the bank sector wasn't a disaster the way that people had anticipated. That led to a pretty sharp rally in that index, lots of names up, almost 100% in some cases. But I think what we've seen over the last few weeks over the last few days, is people going back over that earnings report season and digesting some of the news and saying, well, maybe things weren't quite as bright as we thought it was. I think today's news from Merrill is just going to compound that as I said, I think one of the things that got the sector enthused. Sorry.
I'm sorry. I want to turn it over to Ron for a quick sec. I apologize for interrupting you, Steve. We had Bank of America went from like 18 to 31. We just saw the share price of Citigroup. It was at 15 and change, went up over 20. Now it's in the 17 range. Ron, what's your sense of whether we were really oversold, or did we get too excited too quickly? What's your approach to the financial element?
Well, I think what we saw was we first got into an oversold condition, and I want to make sure that everybody understands that I don't view the oversold condition as a bad valuation. I think that the stocks are probably going to go back down there and probably should be down there. The fact of the matter is they got down there too fast. And then we had an oversold condition. The banks started to rally. And with the SEC reinstituting the uptick rule, we had some encouragement on these banks that some type of support was going to be there for them from the federal government. The fact of the matter is then they went ahead and they became overbought too quickly. So obviously people aren't sure how to really read this, but the banks are in some serious trouble. This is just showing the Merrill Lynch situation is just showing how serious it's going to spread to the rest of the industry. We're going back down in the financials.
Steve, hi, it's Louisa in London. We're going back down the financials. Are we also going back down in the rest of the market, or is it going to be once again the line about financials are doing their thing and the rest of the market will recover in due course?
No, we don't have a lot of optimism for the general direction of the market right now. Obviously, a lot of the tone will be set today by some of the macro data, the Case-Shiller and the consumer confidence numbers. But increasingly that we're seeing that companies are reporting pretty poor conditions. Even those that have reported reasonable second quarter numbers are giving pretty non-robust guidance. Increasingly we're seeing that European companies are starting to paint a bleaker macro picture as well. It'll be interesting to see what both Coach and Colgate report this morning, but it feels like the consumer is under increasing strength. Commodity prices where they are hurting the consumer pocket, but more importantly, they're also, for the stock market, they're also hurting corporate profitability, and it feels like direction right now is still down.
Ron, it's Louisa again. What type of plays are you seeing in the options market at the moment, and where are the smart plays being made?
Well, we are in a bear market, and the one thing we have to realize, especially investors, is, when you're in a bear market, your opportunities are on the downside, and unfortunately, most investors are not really fluent in trading bear markets. They're not comfortable being short or trading the downside, and right now, most of the opportunities are to the downside, and hopefully investors will start to understand this better as they get more and more involved with their own investments and management of their own investments. But I still see most of your opportunities still to the downside. I don't think we're out of this crisis, and to be quite honest, I think we're only about halfway there, maybe even a little less than halfway there. This is definitely not the end of it. There's definitely, unfortunately, a lot more to come, with Merrill pretty much giving up and smashing the hull today. That news is I wouldn't say devastating, but it's definitely putting things into perspective. Dumping at 22 cents on the dollar and giving up on it at that price, a lot of people, I think, had hope for the financials in a sense that if they wrote it down now, there was a chance that, in the future it would bounce back. I think Merrill's saying that, I don't know, if the future is going to have a bounce back. It's better for us to dump this now, get rid of it, clean our books, get lean and mean, and start fighting forward. And they're going to give up any type of potential bounce back. If we see that industry-wide, there's going to be a lot more write-downs and a lot more downside to come. There's a lot more banks and investment banks in Merrill's situation that if they come to do the same thing Merrill did, investors aren't going to be too happy for a while with this market. And you're not going anywhere with this market without your financials going with you. So it looks like downside.
Ron, let me jump in. This is Christine all the way here in Asia. For people who still want to invest in the market and are just waiting at the sidelines, what do we need to see for some capitulation to take place, for signs that things might have bottomed, for people to jump back in?
Well, I think there's a couple things. Number one, I think we need to see the banks show confidence in themselves. It's really hard to get confident in a company as an investor when you're seeing a lot of lack of confidence from, the actual leadership of the company. Right now, from what I understand, banks are lending to each other at the highest rate over prime ever. That tells me that the banks are not only not confident in the other banks' positions, but not confident in their own position. We've heard about the Bear Stearns deal, and one of the things that I thought was very telling was that the Fed said that the only person that really even came up with any type of offer was J.P. Morgan. And here was an opportunity for someone to take over Bear at what everyone was saying was an absolute steal. And no one wanted to come to the table except J.P. Morgan. So my thing is that just shows me a real lack of confidence. I think that we have to see more situations like Merrill, completely smashing the hull. We've got to see a bottom before we can see a bounce. And until we start seeing a lot of these banks showing more confidence, stripping their books, disclosing what's really going on, and taking the write-downs that they should take, I don't see a real bottom in this yet, and I don't see any reason to be optimistic until somebody shows me that, hey, there's reason to be optimistic in us with some confidence, and I'm not seeing that in the financials right now, just from the way that they're acting.
Mm-hmm. Steve, do you agree with Ron?
Yeah, I have to say I do agree with virtually all of that. I think the question of banks having confidence in both their own balance sheet and others' balance sheet is crucial, and a lot of that is going to be linked to house prices. And until people have confidence in the value of mortgage debt and debt attached to the value of home prices, I think anyone's going to struggle to confidently lend in this market.
Well, it's interesting, guys, because 22 cents on the dollar for those elements that Merrill's selling, they got to be worth more at some point. You wonder if they're taking too short a term approach. We'll see how it bears itself out. We do appreciate the insight. Steve Weeple, head of U.S. equities at Standard Life Investments, and Ron Ianieri, chief options strategist at Options University. Thanks for getting up early with us on Worldwide Exchange.